Welcome back to another episode of Smart Money Moves. Today, we're diving into a classic, yet sometimes overlooked part of investing, bonds.
Yep, bonds often don't get the same spotlight as stocks or crypto, but they play a crucial role in building a stable, balanced portfolio.
So let's start with the basics. What is a bond exactly?
At its core, a bond is a loan. When you buy a bond, you're lending money to a government, a corporation, or even a municipality. In return, they pay you interest, usually at regular intervals, and pay back the face value when the bond matures.
It's kind of like being the bank, right? You give them cash up front, they pay you for using it, and then return your money later.
Exactly. And because of that fixed interest, bonds are often called fixed income securities. They're great for investors looking for predictable income.
Now, not all bonds are created equal. There are different types, and they come with different levels of risk and return.
Right. Let's break them down. First up, government bonds. These are issued by national governments and are considered super safe. In the U.S., we're talking treasury bonds, notes, and bills.
Safety comes at a cost, though, lower returns. But for conservative investors or those close to retirement, that trade-off is often worth it.
Then you've got corporate bonds. These are issued by companies and tend to offer higher interest rates than government bonds. But they come with more risk.
Because if the company goes under, there's a chance you won't get your money back. That's where credit ratings come into play, right?
Exactly. A AAA rating means the company is rock solid. But go down to junk bond territory, and you're taking on serious risk for higher potential yield.
Municipal bonds, or munis, are another category. Issued by cities or states to fund public projects, they're often tax exempt, which makes them attractive to investors in higher tax brackets.
Especially if you're looking to keep more of your income and you're not chasing massive returns. And then we have treasury bonds, which are long-term U.S. government bonds, often seen as virtually risk-free.
So how do bonds actually work? What are the key parts people need to understand?
There are 4 biggies: the face value, which is what you get back at maturity, the coupon rate, which is your interest, the maturity date when you're paid back, and the issuer, which tells you who you're lending to.
And while bonds seem simple, there's more under the hood, like interest rate risk.
Yeah, when interest rates go up, bond prices fall. It's an inverse relationship that can surprise new investors.
Especially if you need to sell the bond before it matures, you might not get what you paid for it.
There's also duration, which measures a bond's sensitivity to interest rate changes. The longer the duration, the more volatile the bond price can be.
And let's not forget inflation risk. Fixed payments might lose value over time if inflation rises faster than expected.
That's where tips come in. Treasury inflation-protected securities. They adjust with inflation and help preserve purchasing power.
Then we have yield, which is basically your return on investment. But yield can change depending on what you paid for the bond and how long you hold it.
So why should anyone consider bonds in their portfolio?
Well, for starters, income. Bonds provide regular interest payments, which can be great for retirees or folks looking for cash flow.
They're also good for capital preservation, especially government and high-grade corporate bonds. If you want to keep your money relatively safe, bonds are a solid choice.
And from a diversification standpoint, bonds help smooth out the bumps when stocks get volatile. They often behave differently from equities.
But they're not without risk. There's always credit risk, interest rate risk, inflation, and even liquidity risk, meaning you might not be able to sell easily.
Still, when used wisely, bonds are a powerful tool. They bring balance, predictability, and stability to your investment game.
Whether you're a newbie investor or a seasoned pro looking to ride out some market turbulence, bonds deserve a spot in your strategy.
That wraps up today's episode. Hope this gives you a better understanding of how bonds can work for you.
Thanks for tuning in. And as always, invest smart, stay curious, and we'll catch you next time on Smart Money Moves.